In this new video series, go behind the scenes of our prop firm, which houses numerous elite 7- and 8-figure traders, to learn our techniques and processes for producing robust, high-accuracy options trading strategies. In this case, a powerful option strategy with an 85% win rate. Hi, I'm Mike Bellafiore, co-founder of SME Capital, and we're a proprietary trading firm located in Midtown Manhattan. And I'm also the author of the trading classic, One Good Trade, and the playbook. In part 3 of this new video series, learn a key trading principle, effective backtesting, that has helped our traders thrive, and how that drove the development of this new and powerful option strategy for you. Let's get to work on sharing this important trading principle and trading strategy so that you can grow your trading account. I was thinking of writing a third trading book that dove into why our 7- and 8-figure a year traders have become so successful. And in doing so, I created a fun template on how to become a 7-figure a year trader. That template is growth mindset, plus passion, plus foundation, plus experiment, plus niche, plus trading edge, plus talent, plus bionic, plus patience, plus perseverance equals the 7-figure trader. And since I've written 2 trading books and we produce numerous videos each week on our YouTube channel with trading instruction, and we're well known in the trading space as being a development firm, often independent traders reach out to me outlining their struggles and asking me for advice. Many point to their personal failings as to why they're not thriving as a trader. I can't hold my winners. I don't take my best trades with enough size. I can't take my losses fast enough. Sound familiar? They are the ones that are doing something wrong, in their opinion. They are doing something wrong. There's something wrong with them that goes into this theorizing. From my seat, after running a proprietary trading firm since 2005, I've learned that that can be true for some traders, but not the majority of struggling traders. What do the majority of struggling traders lack? Traders who are not reaching their goals, traders who want to do better, traders who know they can do better. Well, a majority of the struggling traders lack trading edge. Trading edge, trading edge, trading edge. They lack trading edge. The trades that they take are not that good. In fact, if we handed these trades to the best traders at our firm, they wouldn't trade them that well either. Better trading, more profitable trading, usually requires you taking better trades, trades with more edge. At our proprietary trading firm, traders learn the setups that our profitable traders are taking daily to consistently pull money from the market. They know these trades work because 5 feet from them are traders banking serious money trading them. Or they develop new trades with edge through study and through backtesting and through measuring how these trades perform in live market conditions. While we place significant risk on our trades, we're not taking significant risk at our firm as our trades have edge. We're making market-stressed and tested bets that have won handsomely in the past. We don't take trades outside of this, or if we do, we know this is a mistake and we stop taking them quickly. We take trades with edge. We develop new trades with edge that we test rigorously. We leave very little to chance or bad breaks or outside factors. We are in control. We are trading with confidence. Now, Seth Freudberg has recently developed a new trade with edge that we definitely should hear more about. Specifically, Seth, can you tell us what you did to develop this new trade?
Well, Mike, what we did was 10 months of grueling work to test every possible combination of ways that we could take options credit spreads and combine them with IQ's adaptive ensemble signal. And I'll tell you, it was a process. It was at times a grueling and frustrating process, but the result was worth it. So what we did was backtest various options credit spread protocols when combined with the IQ signal. And there's a lot of combinations that needed to be tested in order to find the best ultimate trade which had the best return with minimal drawdowns. And so we backtested. And you may want to step back a little bit and ask yourself, why do prop firms backtest at all? Well, I want you to think about it. Would you buy a house without inspecting it? That's the biggest investment most people will make in their lives, is their home. All right, would you buy it without inspecting it? Well, if you would not do that, you certainly would not expose your capital to a strategy until you've backtested it. You could have a case where after a very short period of time, you've reached the conclusion that a trade is successful, but that could have just been luck. That could have been simply random, and you don't know that until you backtest it. The fact is that testing a statistically significant number of trades using the same protocol is much more conclusive about validating a trading idea. And in doing so, you're bringing out that system's tendencies in different types of markets to help you to hone the strategy for a future test. By backtesting, you're narrowing down the best performing protocols for the most robust strategies. So for all those good reasons, prop firms are big on backtesting and validating strategies that they're going to be putting millions of dollars of capital behind. We realize that most retail traders don't have the expertise and training to perform a properly designed backtest that would meet professional standards, and so SMB has taken care of that for you. We've developed a highly profitable one-day options trading system based on the IQ signal that can easily be implemented by traders of any experience level in just minutes a day. If you're interested in learning more about exactly how that system works, go ahead, click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. I think you'll be pretty intrigued by what we've developed for you, so pause this video, sign up now, and then resume watching. What did we look at? This was a joint venture operation between Scott's team in North Carolina, down at InvestaQuant, and SMB's team here in New York. And we had lots of resources involved in this process. One of the early questions we had to ask ourselves is, how close do we put the credit spreads to the market? Because the fact is, the closer that credit spread is to the opening price of the SPX index, the more money you'll make on winning trades, but you're going to lose more trades. Whereas the farther you are away from the market, it's a much safer trade, but you will make much less, therefore have a much higher win rate, but much smaller wins. So we had to look at that trade-off. We had to decide what's better, lots more wins and smaller dollars per win, or less wins, but much bigger wins. And without testing, you can't really know how that will come out. Another question we looked at very closely was, how far did we put our short option from our long option? Now, as you saw in the previous video, the long option is the one that controls your risk in an options credit spread. The farther away you put that long from your short, the more risk you have on the trade. So what does that mean? If the long option is close to the short option, you will have much smaller drawdowns, but you'll make less on each trade. Whereas the farther apart the short and the long option are, the more profit you'll make per trade, but you have a much more volatile outcome, although you may very well and most likely will have a higher expectancy on the strategy. Another issue we looked at, which was very, very important as it turned out, was how far in advance of expiration should the trade be initiated. We looked very hard at trading Tuesday and Thursday, which are the day before expirations of Wednesday and Friday. We found out that, in fact, the Tuesday and Thursday trades had almost no expectancy, whereas the trades traded on the days those options expired, Monday, Wednesday, and Friday, those did, in fact, have a very solid expectancy with minimal drawdowns. That was not intuitive to us. It was something that we had to glean from backtesting. In fact, when we went into this, we were convinced that Tuesday, Thursdays would also have a positive expectancy. We did not expect that outcome. We understood the outcome, but we didn't expect it completely. Another very important topic we looked at is what time of day do we start the trade? You could start it immediately on the opening bell when, in fact, the signal is generated at 9:30. You could start the trade at 9:45, giving the market perhaps a little time to settle down or find direction. You could even start it at 10 a.m. We looked at each of those issues. The conclusion was that it was best to start it as close as possible to when the market opened, but it turns out that that delay within that first 15 minutes or so is not that significant. Once you go to 10 o'clock, then you have a problem because so much of the premium has been sucked out of the options by that point, even only 30 minutes into the market.
Seth, if I can add to that, that was a big surprise to me especially because I really thought it was going to be super time sensitive to entering at the open. But almost half the trades actually had a more favorable credit 15 minutes afterwards. It was in the 40 percentile. Still the majority, it's better to get in at the open, but you didn't have to be in at the open every time. If you got in with the first 15 minutes, it was nice because sometimes life happens and you can't execute right at 9:30. So that was a surprise to me.
Another very important issue which we focused on in our backtesting project was which vehicle should we use to express Scott's signal. You see, Scott's signal works using the S&P 500 futures, the ES futures, which trade essentially 24 hours a day, yet the signal is generated at the start of the cash market at 9:30 in the morning. And so we had to look at which options should we use. We realized with SPY shares and futures options, if the short options closed in the money, you would actually be assigned SPY shares or assigned futures contracts. Well, that's not tenable for lots of reasons. That creates complications for a prop firm. So we decided the very clean thing to do was to adopt this system by using SPX index options, which, as we explained in a previous video, are cash settled and therefore very simple.
So Seth, if I may add, we did so much it's hard to remember it all, but a couple other things that I remember us doing was testing different volatility regimes using the VIX because our signal does not incorporate the VIX in generating it, so it was nice to look at it and evaluate it. This was also a little bit of a surprise to me in that while we had different credit amounts, right, for different volatility regimes, the performance of the signal held up. So the payoff was there, the expectancy was there for all three regimes, though it does seem to prefer, and we always like to have a little extra credit when we can get it right. Another thing, and perhaps the biggest breakthrough we had, and it was a big surprise, was with the SPX. Since we're futures traders, we didn't realize this. You knew it, but we didn't. The opening price, what is shown on your charts when you trade the SPX, is not a real price. The SPX is not tradable. It's actually just a starting point. The actual open is an average of price action that happens sometimes for multiple minutes after the open. So we had to create some type of a proxy, if you recall. And that was a pretty big process for us to try to figure out how to estimate the relative opening price for the SPX relative to the futures contract, which is what the signal was based on. It took a while, but we eventually figured that out. And then when we measured it, it impacted almost 30% of the trades. So getting that right was a huge breakthrough for us. Otherwise, it would have hurt us. And I'm glad we realized it when we did.
And that's a good example of something that you wouldn't have even thought of when you first entered into this project. But as you go deeper into the verification process, you come upon issues that seem very small on the surface and may take months to actually overcome. That's the kind of work you've got to do to validate a system. And just when we thought we were done, we asked ourselves the following question. Was 3 years of data enough? And we had a rather large team of top flight, world-renowned in some cases, traders looking at this system as we developed it. And the answer was no. We want more data. We want more verification of this system if we're going to trade our capital with it. So we went back to 2008, 10 more years into the past to, again, test the options credit spreads against or incorporating the IQ adaptive ensemble signal. And guess what? we ran into a little bit of a problem. And that problem is that Monday, Wednesday, and Friday options didn't exist before late 2017, early 2018. They simply did not exist. So how are we going to verify a signal against an option that never existed? The answer is we decided to create a model that basically mimicked what the options would have looked like had a Monday, Wednesday, Friday option chain been available in those years 2008, 2018. Some people may think this is overkill, but when you're talking about millions of dollars of capital, you do overkill. Let's face it. And so we worked months to create a sophisticated model to estimate the premiums you would have received on Monday, Wednesday, and Friday from 2008 to 2018 in varying volatility conditions, as Scott just mentioned. We looked at the wins and loss rates because we had a certain win and loss rate between 2018 and 2020. Did that hold up over that previous 10-year period? Or did we just get lucky between 2018 and 2020? We looked at the sizes of wins and the sizes of losses during those periods of time. You could have the same win rate, but radically different win sizes and loss sizes. That would massively change the outcome if that had changed. And we also looked at the returns and how they compared to drawdowns, which is a critical measurement that every prop firm goes through to validate whether they would accept the system and expose their capital to it.
Seth, those are great points, and if I can just add a little bit from the technical perspective, one of the challenges that proved out, fortunately, was trying to identify the factors that we wanted to create the regression model to approximate the credit spreads and debits, right, to build the actual underpinning of the model to come up with these great results. We ended up settling on several key factors that we identified. The regime, right, the volatility greatly impacted the credits and the debits as well. The day of the week, even Monday, Wednesday, Fridays matters in this case. And then how much we're rounding to get, or the proximity, I should say, to the nearest strike price, right? And all those were factors that went into the model that allowed us to approximate, not perfectly because it was a simulation, but with a high degree of confidence that we were in the ballpark of how the option prices would have been priced had the daily and weekly options been available prior to 2018.
The conclusion, fortunately, was that the system worked remarkably well in all of those markets over that now 12-year period that we analyzed. In fact, the lowest hypothetical return over that 10-year period was 13.53%, which is double just about double the average S&P 500 return in a year. The highest hypothetical return over that 10-year period was 89.39%, including 5 years in a row above 50%. So we were pleased that we went into this process, and of course we were very excited by the outcome, but without such a process, we would not have been able to be comfortable exposing our capital. So as I mentioned earlier, regardless of the type of trader you are and your experience level, you can utilize our system to augment your main trading activities because the IQ signal only occurs 2 to 3 times a month on average and can be executed in under a minute the few times per month that you do receive a signal. We'd encourage you to attend the webinar where we can offer you this system at a huge discount. So just go ahead, click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in the new window. I think you're going to be pretty intrigued by what we've developed for you. So sign up now to arm yourself with this powerful trading signal before it's too late.